Welcome to the EQUIS Institute, and welcome to Nathalie Pistre, who's Head of Quantitative Research, Support and Development at Natixis Asset Management. In the context of the partnership with l'Association Française de la Gestion Financière, we have a series of discussions and presentations on risk management as a source of performance. Today, we are going to talk about bond portfolio optimization. I will start with a presentation of the key challenges involved in bond portfolio optimization, and Nathalie will follow up with a discussion on how to introduce active use in the context of bond portfolio optimization. There's actually much less academic research on bond portfolio optimization models compared to what is available in the equity universe, where there's a lot of understanding of how we should optimally construct portfolios. It's not totally clear why so much interest has been and can be found in equity portfolios and much less in bond markets. One possible explanation, which is not fully convincing, but one possible explanation is that most investors would hold bonds for hedging purposes as opposed to diversification purposes. So, in this spirit, the focus would be on duration matching, for example, as opposed to maximizing risk-reward ratio. Well, that explanation is not entirely convincing for the following reason. I mean, for one thing, there are actually infinitely many bond portfolios with a given duration constraint. So still remains, after taking care of the duration constraint, still remains the task and the challenge of constructing an efficient portfolio. And in any case, other investors are holding portfolios for purely performance-seeking purposes. So that's not necessarily why this is not the case. There are other possible explanations as well. One of these explanations is that, well, it's not even worth doing it. There are small benefits that can be expected from bond portfolio optimization. And the rationale behind this kind of explanation would be that bond returns would be much more highly correlated compared to equity returns, and therefore the expected benefits of diversification would be smaller. Well, that might actually be true in a fairly homogeneous universe, like treasury bonds from a given state, sovereign state. But if you look at corporate bonds or even sovereign bonds, but across different countries, then, well, it is certainly the case that some diversification benefits remain and that they may be substantial. Another explanation is perhaps that this is actually a more complex problem. And the reason why it's a more complex problem is because the universe and the securities themselves are constantly evolving. And this is due to the finite maturity of bonds compared to equity, right? So as we move on in time, bonds are actually evolving. So if you start with a 5-year bond today, a year later, it's a 4-year bond. So it's actually a different security. If you start with Apple today, a year later, it's still Apple. Maybe the business model has changed and has evolved, but it's still the same company. Well, in this case, the security itself changes, and then eventually, of course, disappears and new bonds are issued. That actually poses a number of problems, and we will be discussing how to handle such problems. Well, there are actually many roads to bond portfolio construction, but before we talk about the different methodologies that people use for constructing bond portfolios, I think it is useful to remember that all of these roads actually should bring us to a unique point, unique destination. And the goal is actually highly unambiguous. The goal should be to harvest risk premia in the most efficient way. So asset owners, investors, endow asset managers with their trust and wealth, and they risk budgets as well. And the challenge for an asset manager is to come up with the most efficient spending of these dollar and risk budgets. Okay? And this is achieved with portfolios that enjoy a high reward per unit of risk. So this is exactly what the target should be. Now, if the target is clear, it's not as clear what's the most efficient way to reach the target. The first approach is, let's call that a very naive approach, equal dollar contribution. You don't need any inputs. You don't need to estimate risk parameters or expected return parameters. You take a set of bonds and you just equally weight them, equal weights to all of them. There's another naive approach, which is slightly more sophisticated, that's based on the recognition that what eventually matters most is not the dollar contribution to securities to a portfolio, but the risk contribution. In this case, the goal is to equalize the contribution of each one of these securities to the portfolio as a whole. Now, to do this, you definitely need risk parameters. You need a covariance matrix for bond returns. There are other objectives that would require covariance matrix. The first one being the minimum variance portfolio. Minimum variance portfolio consists of just minimizing portfolio risk, say portfolio volatility. And in this case, again, the only inputs required are risk parameters. Again, covariance matrix parameters. Now there's a slightly more ambitious goal, which is maximizing the Sharpe ratio. Well, that sounds pretty consistent with, as a mean goal, with respect to our end goal, which was precisely harvesting risk premia in an efficient manner. The problem with the max Sharpe ratio diversification objective is that it does not only require risk parameters, but also expected return parameters, which is a bit more complex. Now, before we move on to the discussion on how to come up with efficient estimates for risk and return parameters, we have to keep in mind, as previously explained, that it is often the case in a lot of contexts, including asset liability management type of context, it is often the case that bond portfolio optimization is performed with the constraint of a given duration target. And so that might be an important constraint to take into account. Okay, let's start with the challenge related to estimating risk parameters. Well, there are two problems, as always, when estimating a covariance matrix. The first problem, we call that the curse of stationarity or non-stationarity, the fact that these parameters are time-varying. And the second challenge is what we call the curse of dimensionality, the fact that these parameters are not only many, but also that they are changing over time. That makes it even more complex. Okay, let's start with the curse of non-stationarity. The problem here is, of course, that stock returns and bond returns volatility varies over time. Also, correlation varies over time and across the business cycle. And we have accumulated evidence that they are not constant. But the situation is actually even worse for bonds because of this finite maturity. Remember what we said? We said a 5-year bond today, in a year from now, will be a 4-year bond. Now, if I'm sitting today, I'm looking at the 5-year bond, and I'm trying to use, let's say, 2 years worth of data to estimate let's say, the volatility on this 5-year bond today, well, the data I'm going to be using actually do not relate to a 5-year bond. They relate to a bond that was 7 years, that was 7-year maturity 2 years ago, and that eventually, slowly but surely, turned into a 5-year maturity bond. So what we're saying is there's a deterministic trend that takes volatility down, and if you don't take that into account, of course, you would end up overestimating volatility using standard statistical techniques such as the ones that we use for equity portfolios. So we need something better. We need to take into account, if you will, the no arbitrage relationships that exist between different bonds across the yield curve. Well, there's a convenient way to do that, which is to precisely using a dynamic term structure model. Typically, we would calibrate a no arbitrage dynamic term structure model, state of the art. There's a lot of reasons in terms of tractability and flexibility to work with what we call Gaussian-affine dynamic term structure models. By doing this, we do the job and would provide you with parameters that would be implicitly or explicitly actually taking into account this time component. There's another way to doing it, which is, well, if you're not fully comfortable with the specification of your term structure model and also the requirement to estimate the parameters in a robust way, you could also use a model-free solution. And the way to do this is you actually express the covariance matrix of coupon-paying bonds in terms of a covariance matrix based on fictitious bonds that do not exist, that are not traded on the market, but these fictitious bonds are constant maturity, pure discount bonds, and these that are extracted from the yield curve. So if you're looking at the time series of the return on these constant maturity pure discount bonds, then the problem of this deterministic trend goes away, and then it's much easier to work with these ones. Once you have estimated the covariance matrix for the pure discount constant maturity bonds, then you can map back to time-varying coupon-paying bonds. That actually works really well. Well, it works well, except that then again you're running into the next problem, which is the curse of dimensionality. There are many such bonds, and you have a limited sample size. So how do you deal with this problem? Well, that is something that we are pretty well equipped with in terms of methodologies, statistical methodologies. Typically, we use a factor model. We'd like to use a parsimonious factor model. In bond markets, especially sovereign bond markets, it's actually feasible to explain most of the returns on a set of securities, on a set of bonds, using very few factors. The first factor, which should be something like the level of interest rates. Second factor, which should be the slope of the yield curve, maybe a curvature factor or convexity factor as well. But with these 2 or 3 factors, we actually explain a fair amount of the information at hand. So that will allow us to actually reduce the dimensionality of the problem. Okay, so the bottom line is, yes, there's a state-of-the-art set of techniques that can be used efficiently to estimate covariant matrices for bond returns that actually are fairly robust and meaningful. Well, but the next challenge is estimating bond expected return. That's much, much more complex. Okay, statistical, purely sample-based estimates for expected returns are well known to be extremely noisy, sample-dependent, contain very little information. So what else can you be doing in this case? Well, the first thing that one can be doing is using a factor model again, just like we've been using the factor model for the covariance matrix. We're now using the factor model for estimating expected return. And this simple equation here allows us to relate excess expected return on bonds to actually risk premia on these few factors, calling capital K the number of factors, say capital K is 3 or 4 or 5, and I just need to estimate the betas of securities with respect to the factors, and then the volatility of the factor, and also the risk premium for these factors. Okay, now there are still a number of challenges to address if one wants to implement this methodology. Challenge number 1, what are the factors that we want to extract? Well, there are 2 ways to go. One is the implicit way, and I was talking about, for example, principal component analysis, which is a statistical method that we can use to extract uncorrelated statistical factors from correlated bond returns. But you can also use explicit factors as well. That's actually an active area of investigation, factor investing in bond markets. Active search for what are the most meaningful factors that collectively can explain cross-sectional differences in expected returns. Okay, let's assume a set of factors is now given and available. So the next question is, we need to estimate the betas and the sigmas and the lambdas in this equation. I mean, the betas and the sigmas, it's okay, it's no big deal. These are risk parameter estimates. You can use standard statistical techniques. Sometimes you can relate them to observable attributes like duration or rating. That is not a big deal. The one that's much more complex is lambda, because lambda is related to the expected return on the factor itself. Well, estimating expected return on a factor is as hard as estimating expected return on a security. There are just fewer of them, but the lack of stability of sample-based expected return estimates is still going to be a problem in this case. So what do we do then if we cannot rely on sample-based information? Well, one way to think about it is actually sample-based information is not useful. In the spirit of Bayesian analysis, I'm actually going to be using a prior. And a prior is going to be something that I think I know about these expected returns, regardless, beyond the information from the sample. So for example, if I use an agnostic prior, I'm going to come up with the assumption that the 3 factors that I'm talking about, say the level, the slope, and the curvature of the yield curve, that the 3 factors have the same reward per unit of risk. Now, this is due to a lack of ability for my part to be able to distinguish which one of these factors will have a higher reward looking forward. It's actually going to be the focus of Natalie's presentation just in a few minutes to actually explain how asset managers can integrate their active views about the expected return on the factors and or the securities in the construction of these meaningful portfolios.
In the fundamental active asset management, we include portfolio manager views in our portfolios. But we want also to be rigorous in the portfolio construction. That's why we rely on theory that explains how to optimize a portfolio with the inclusion of portfolio manager views. What do we call views exactly? The portfolio manager views are basically directional bets along a certain risk dimension or factor. So for instance, we would say that we have a bullish view on credit if we think that spreads will tighten in the future, for example, in the next months. We would say that we have a bearish view on 10-year German rates if we think that the 10-year German rates will rise in the next future. In general, we draw a correspondence between the views and the expected movements of the underlying risk factors or the underlying asset prices. For instance, in the case of a directional credit call, we have this type of correspondence. If we are very bull on the directional credit view, it could mean that we think that the spread will decrease more than minus 10% in the next month. This is the type of correspondence we have.
Nathalie, let me ask you a question. Active management can be based either on security selection skills or on factor timing skills. In these particular examples, the views that we're looking at, do they relate to security performance or to factor performance?
So in this case, in this example, this is really the directional factor. We have a view on the directional factor. It means that we think that, for instance, the general credit spread will increase or decrease depending on our view. So this is not security selection. For instance, in our credit process management, we have this directional factor. We also have sector factors, so we express views about which sector will increase or decrease, I mean sector spreads. And we also have the selection security skill. And we try to combine everything in the same portfolio and to be coherent with the three aspects. So in the risk-return optimization of the actively managed portfolio, as you can see, the expected returns are conditional to the portfolio manager's subjective views. It's really discretionary, fundamental, and a view. But for the risk modeling, we remain on the statistical computation that Lionel was speaking about just before. As you know, we call the active return also alpha, the difference between the return of the portfolio and the return of the benchmark. Either ex ante, this is the difference in the expectation, or ex post, the difference between the two realized returns. As you may know, we call the information ratio as the alpha, the active return, divided by the tracking error. So we are speaking about a benchmark portfolio, so a portfolio with a reference.
Nathalie, when we look at the information ratio, we see that it's a function of alpha, but also tracking error. It seems to me that tracking error is a risk budget that is set by the asset owner, by the investor, and not by the asset manager. Could you comment on this?
So in fact, you have the two aspects. The limit in tracking error, so the budget, the limit budget that you have, is given by the asset owner. Always, I would say. But the portfolio manager can choose to be under this limit or to have a target under this limit. He can even choose not to be on the target always. I mean to be under or over the target depending on his risk appetite or depending on the way he thinks that risk will be rewarded at this moment in the market. So the information ratio, in fact, has two aspects. It measures the quality of investment opportunities in an active management process, and it measures also the ability of portfolio manager to add value or to add performance. So in fact, we have a theory that links added value to these two aspects. So the first was Greenall speaking about the fundamental law of active management, and he distinguishes these two sources of value. He names information coefficient or skill. We use skill in general in the market. The correlation between the returns and the forecast. So this is the way the portfolio manager is skilled in forecasting returns. And we have also the number of times a year where we can use this skill that we name breadth. He states, the fundamental law of active management states that, in fact, the information ratio that we were speaking about is almost equal to the information coefficient, the skill, times the square root of the breadth. And so you can see that we will have some trade-offs, because in fact, you will have a trade-off between the skill and the breadth, because the more you use a strategy, the less you are skilled about this strategy in general. You have a trade-off between the scalability and the capacity of the market, because you would like to be scalable, to increase the number of times you use the strategy, but you have also the capacity of the market, what we can call today the liquidity of the market, for instance. And we have also a trade-off because you cannot generate the outcomes you want if you have constraint on the portfolio. So you can see in fact, the ISO curves for the information ratio between the IC and the breadth on the slide. There is formulation. The initial formulation determines the added value without taking into account the portfolio constraints. After that, there are other papers that speak about the constraints of the portfolio, and we always have constraints on portfolio that we manage for other people. And so Clark has defined the transfer coefficient as the correlation between the positions and the forecast, and the position reflects the constraints. So in fact, the information ratio is decreased, and as you can see, it's almost equal to the IC times the square of the breadth times this coefficient, this transfer coefficient. So of course, taking investment constraint into account limits opportunities and decrease the information ratio. You also have a link which is very interesting between the IC and the probability of being right for a portfolio manager. So you can see this. Equality between the IC, which is equal to 2 point the probability minus 1, which means that if you have 55% chance of making the right call, it corresponds to an IC of 10%. So an IC of 10% is already very good on the market. If the strategy is rebalanced every month based on new information, as we see before, the fundamental law of active management will say that the information ratio will be this 10% times the square root of 12, so it's 0.35. And the expected alpha is thus proportional to the amount of active risk of the strategy by this information ratio. So you have very simple way of expressing all this. Greenall added a new notion, which is view, and the view, in fact, are or scores are in fact the normalized forecast on assets. We were speaking about forecasts just before, and so views are normalized forecasts on assets, centered and reduced. And it shows that the alpha is the IC times the tracking error times this score. So in fact, given a forecast, we can determine the alpha by scaling the forecast by the risk and the information coefficient, which is very helpful. For instance, if the IC is 0, any score is generates a null alpha because it's information-less. The combination of the independent views is important also. So we can show that the square information ratio of an independent strategy adds up to the square of the overall total information ratio, as you can see on the equation. So let's take an example. We consider two independent strategies, a monthly directional one and a quarterly based allocation one. And you have the characteristic of both strategy in the table, and we can have also the combination. Okay, so we suppose that P, which is the probability of being right, is 0.57 for the directional strategy and 0.63 for the allocation strategy. So you can compute the IC for each one with the previous equation. The breadth is obvious because one strategy is monthly, the other one is quarterly, so the breadth is 12 for the first one and 4 for the other one. And we suppose that the information ratio is the same for the two strategies. It's an example, okay? So you can find the combined information ratio of the two strategies with the equation. And so you see instantaneously that the combined information ratio is better due to the independence. And you have the breadth of the combined strategy with this 16. And using the previous equations, you find the IC and you find the probability of being right. But the information ratio is obviously increased because of that. If you have a combination of correlated view, it will be less better, of course, because in fact, the more it's correlated, the less you benefit from the information ratio of the two strategies. So what do we do in the end? In the end, we have these optimal portfolio constructions with the views and with the skills. So as you can see, you have the risk factor views, you have the skills of the portfolio managers, and you have also the historical volatilities and correlations. On the other side, you have the risk budget that you choose, and you have also the constraints of the investor. And so the portfolio construction takes all this into account. So you will have an optimal allocation of risk with tactical view and optimal exposure and asset allocation with tactical views and with the skills. So you have the objective function on the right-hand side. So as we can see, we maximize, in fact, the sum of expected alphas, taking into account the information coefficient for each strategy, taking into account the breadth of each strategy, the tracking error of each strategy, and the view on each strategy. Obviously, we have a risk budget, which is what we call the active risk, which is the tracking error, in fact. And I gave you an example of how we express the views. So there are numeral figures, and they would take values in the set -2, -1, 0, 1, 2, which a range of exposure defined for each view. So for instance, if you want to be overexposure, if you have a very, very bullish view, you will have a view of 2. And this combination will give us, in fact, the optimal asset allocation or strategy allocation in the portfolio.
Could you give us an example?
Okay, I will give you an example on what we call the aggregate process. Aggregate means that you have an investment universe with interest rates and credits. So in this example, the portfolio manager defines views for the different strategy. So for instance, he has views on allocation. He wants to be long corporate versus German bonds. He wants to be short sovereign versus German bonds. He wants to be long Spain bonds versus Belgium and long Italy versus French. So these are the allocation views, but he wants also to be short duration and long emerging bonds. Why emerging bond is not allocation? Because emerging bond doesn't belong to the benchmark, so it's a diversification strategy. So in fact, you have two figures. The first one is the portfolio optimization, supposing that the skills are equal for all the strategies. And so the portfolio optimizer will give you the weights on each strategy, the risk attribution on each strategy, and also the alpha attribution on each strategy. On the other side here, you have a skill which is increased from 10 to 20% for the allocation strategies. So we suppose that the portfolio manager is better for the allocation strategies than for the other ones. So in fact, you have the optimization of the portfolio, which is different, because the optimizer gives more weight, more risk on the strategies for which you have a better skill. And in both cases, the overall tracking error is 30%. So it shows that with the same level of risk, you can have very, very different portfolios with very different risk contribution and obviously different alpha contribution and different global alpha for the portfolio. It illustrates the way we do.
I've got a question at this stage. To implement the process, you need to have a measure of manager skills. How exactly do you go about estimating manager skills in the first place?
So in fact, we observe them. I think we have been observing them for 10 years, something like that. And so we have a database basis with all the strategy, all the views. So we are able to compute the hit ratios, what we call the hit ratios. And the hit ratio is the equivalent of the probability that we have before. So with the hit ratio, we are able to compute the skills. It's a long time work because you have to have a lot of strategy in your databases in order to have a robust estimation of your skills. That's the way we do. And so we are able to see where they are more skilled and where they are less skilled.
I would like to thank Nathalie for this most insightful presentation. It actually is extremely interesting to see that one can provide a coherent framework that allows asset managers to optimize portfolios based on their active use while respecting the risk budgets set by investors. Such a comprehensive framework is actually needed to make sure that whatever portfolios that we're holding is consistent with our views. When you think about it, it is actually okay for any asset manager to express views that eventually turn out to be wrong. What's not okay is that in the absence of a rigorous risk management framework, we may actually be holding portfolios that are not even consistent with our own views. Well, I hope you have enjoyed this presentation as much as I have, and I would like to encourage you to provide us with any feedback, question, comment that you may have. This would be extremely useful.